Welcome, welcome, welcome to my Pincast for Chapter 11. And if you can't say anything else for Chapter 11, you can say one thing. Wahoo! It is the last one. Yes. This chapter's topic is on current liabilities and payroll. I will break this up into smaller bite-sized pieces. And the good news is the first piece on Notes Payable is almost totally review. We already learned Notes Receivable and Notes Payable. It's just the other side of the coin. So, we're going to look at Notes Payable. And let's get started. The first thing I'd like to say is that the calculation of the maturity date is just like we calculated with notes receivable. The calculation of interest is just like we calculated with notes receivable. And the calculation of the maturity value is once again just like we calculated with notes receivable. So a lot of this will be a review. For our example, on Notes Payable, I would like to utilize a $10,000 9-month 12% note. I'm going to use a time diagram. I like time diagrams. I think they help us get a handle on things. This company has a calendar year-end and a fiscal year-end that are both 12/31. And on our facts, on 9/1, they are going to issue a note. So on 9/1, they'll issue a note for cash. In other words, they'll borrow money. We'll go through year end, so there'll be an adjusting entry that's required. 12/31, because as you'll remember from Chapter 9, interest accrues by a day. And then on 9 months, on the eve of 9 months, or June 1st, the note will come due on its maturity date and be paid. Let's look at the journal entries for all three of these events. Oops, all three of these events. Go away. On 9/1, we sign a note borrowing $10,000. And so we receive cash of $10,000, and we sign a notes payable for $10,000, and you have just now increased your liabilities. Time passes, and you have this cash in your possession from 9/1 to December 31st, and so you owe them some interest. How much time has passed? September, October, November, and December. And if you'll recall from Chapter 9, our formula is principal, 10,000, times the rate, always assumed to be annual, times the time period involved. In this case, how much time has elapsed from when you signed the note to end of the year, and that is 4 months. So since 4 months has passed from year end, you could use this calculation to determine how much interest payable. We'll have interest expense as one entry and interest payable as the other side of the entry. 10,000 times 12% gives us $1,000 a year, or $100 a month times 4 months equals $400. So interest for the period from September 1st through our calendar year end, or 4 months, is $400. Some more time passes now, and we get to June 1st. It's now the maturity date, and the note needs to be paid. How will we calculate this payment? Well, first of all, we know we're going to pay a notes payable in the amount of $10,000, so that part of the entry, pretty self-explanatory. How much is the cash part of this entry going to be? How much cash are we going to owe? Well, let's do a maturity value calculation. $10,000, 12%, 9 months equals $900. So maturity value is the 10,000 plus 900. 10,000 principal, 900 interest. The cash will be $10,900. We have two of our answers. Notes payable will be debited for $10,000 and the cash will be credited for $10,900. Remember further that we set up a payable at the end of the year, so interest payable can now be removed in the amount of $400, and we still have the need for another debit. We need to pick up interest for the period from 12/31 to 6/1, or 5 more months. So interest expense for the current period now needs to be recorded. That would be $10,000 times 12%. And recall, from January 1st to June 1st includes January, February, March, April, and May, or 5 more months, which means interest expense for the current